what if I told you that while everyone is obsessing on Nvidia and AI stocks, there's a golden opportunity that we are missing? That's right. We're talking about gold. But before you start rolling your eyes and start calling gold stocks boring because nobody talks about them, I'm going to share with you 2 stocks and 2 ETFs that are likely to even outperform Nvidia's returns. In this video, I'm going to show you why gold is a secret weapon that your portfolio needs right now. I will show you 2 gold stocks that are ready to pop. One of them is really going to surprise you. And I will also share 2 ETFs that are even likely to be better than those stocks. In this video, I'm using the same strategy that I used recently on Tesla, and the viewers of this channel saw a 30% return in just 4 days. Yeah, that happened just last week. But that's not all. If you sign up for my newsletter in the description below, I will share with you my most profitable stock strategy. Beginners and professionals can use this strategy. It is a strategy that helped me make a 70% profit in HIM stock in only 2 weeks. Don't let that chance slip away. Sign up to the newsletter, get that free lesson, and go through it. Subscribe to the channel and turn on your notifications because I release these videos a day before the stock market opens so that you can profit in time. The first thing that we need to know is that 80% of the time, stocks will be following their industry. So we want to make sure that the industry is going up. So this is a gold industry and this is a gold stock, for example. This is HMY, which is a gold stock, and up here is a chart of the gold industry. You can see very easily that when the gold industry is going up, the gold stock is going to go up. When the gold industry is going down, the gold stock will go down. When the gold industry is going up, the gold stock will go down. But of course, they go up different percentages. So here, the gold industry went up 40%, but this gold stock went up 90%. So you want to be in the best stock in the sector. And that is what this video is going to do. I try to put you into the best stock that is going to bring you the biggest return. And the first stock that we're looking at, of course, is HMY. And it has some secret signals that most investors cannot see, but I'll share them with you. The first thing that we have to see is that has it completed a base? Anything less than 4 weeks is not a good consolidation. On this side, we have a 4-day chart, and I have a daily chart on this side. This white line is a 50-day moving average. So we can see that it has clearly sat for more than 4 weeks, and that is a good sign. The next thing we have to look for is earnings. What are the earnings of this company? We can see that the earnings are terrible. It is not making a profit on the earnings per shares. It is losing money. The revenue is not growing as much, but with such stocks in commodities, it doesn't matter right now because if gold is going to be making money, then the profits are likely to show up way later. They're not like tech stocks where you have to see the profits right now. But the return on equity is looking okay. Stocks that are commodities, even without good earnings currently, are likely to go up. So on the earnings part, it's okay because we're not looking at the earnings very strongly because the whole industry of gold is moving up. So the stock will go up regardless. We just want to be in the best stock. The next thing is to look at the details of the base. What is happening? And one really interesting detail is something called a shakeout. The base has a line of support here. We can see it bounces off this line 2 times, then goes up to fake us out, and then comes down and then shakes out the people. It goes slightly below the line of support and then comes up on huge volume very quickly. This is something called a shakeout, and huge investors use this to try to scare people out of a position. But of course, we shouldn't be scared out of this position because we know that after a stock does something like a cup and handle that we can see here, this is like a cup and handle that happened. It had another base here. We know that the stock had not likely finished until it goes through a 20 to 30% correction. And it did that here. It went up again. And this is something called the third base. And the third base is still a good time to get into the stock. It's risky, but it's still a good time. So after that shakeout, that's the first good sign. We see the stock sit for about a whole week here where the price was not going anywhere. And it did so on very low volume. So when you see a stock sitting down for a week 3 days, 4 days, 5 to 10 days, and the price is not really going anywhere and it's doing some low volume, that means the sellers have been extinguished. People are not willing to sell the stock anymore. So as soon as anyone comes in to buy the stock, it will just jump up. So that's why we see this huge gap up on the next day. And this was a good time to get in. Of course, I already bought the stock around $9.2, but it is not yet late to enter this stock. You can still buy it here at $9.6 and put your stop loss to be about $9.3. And that is about a 3% stop loss, which is a very tight and good loss. So if you put in $1,000, you're likely to lose only $30, which I think is just a good loss for the potential rewards that I'm about to show you. So to predict where the stock might go, we get 1.5 times the average true range, which is about 5%. So we put in 5%, and we know that it's likely to do 5 to 6 times of that. So we just put in here 25% return. This is our first goal here. We have to see how it's gonna react. Of course, our stop would be about 3%. So you have a risk to reward ratio of 8, as we can see, about 8 to 1, which is a good risk to reward ratio. The next thing that you have to watch out for this particular stock is this resistance. How is it gonna react to these highs? If it comes here to around $10 and falters, then you know that this is also another fake move. And then you might even get out without incurring a loss. So that's a good thing about this stock. Let's go into another stock that I really like. And this one is even looking better. And this is a company called CDE. The revenue is not that great. We want 15% of the last 4 quarters or 20% average in the last 2. It doesn't have that. Earnings per share, we want an average of 30% for the last 4 quarters. It doesn't have that. Return on equity, we want 17% at least. It doesn't have that. So it's not a super growth stock, but because of interest rates, gold is likely to move up and is currently moving up. That means that these gold mining companies are going to be making profits in the future. That's what investors are looking at. They're not looking at today. They're looking at the future, and we can see it in the weekly chart. The first thing that we can see that the stock went up 100%. And what happens after the stock goes up 100%? We can draw a line here. Nobody's willing to sell the stock. If you see such tight weekly action, the stock didn't go down. People were not willing to sell the stock. People who bought it already were like, hey, we're not giving it to you. You have to buy it at a higher price if you want to get it from us. So you see these tight actions on also low volume down here. And then when it jumps out, another good sign is that we can see that the 50-day moving average is sloping up. This tight action is just above the 50-day moving average. And then it gaps up. The best day to buy it was supposed to be on this day where it was around $6. That was a good buy. You can put a stop of about 5%. But even this breakout to $6.2 is not, you're not yet out of the zone where it becomes risky. So if you're buying it here, I would say put your stop to be around just 6%. And where can we predict the stock to go? I told you we put in this number 1.5 times the average true range. Put in 7.6. Put 5 times, so we know it's likely to go up around 37%, 30%. So you can just aim for around 30%. Put in your risk of about 5.4, so you have a 6.1 risk to reward ratio in case the stock goes in your favor. After that, we go to look at the ETF because some people don't like to risk particular stocks because they're like, hey, the stock might just collapse. GDXU, so this is a leveraged ETF for gold miners. Those are companies that mine gold and profit when gold goes up in price. And currently, gold is going up in price. That's why these gold miners are going up in price, because since they have gold and gold is going up in price, that means that they're going to be making profit when they sell that gold. So this is a 3 times leveraged ETF for gold. And we can see it has huge swings. Last time it did 50% in just 2 weeks. So you want to be very careful in such very volatile ETFs. We want a tight stop, and then if it goes in our favor, we're likely to make huge profits. For ETFs, you can just expect around 4 to 5 times their 1.5 average true range, which is currently 10. Put it in. We can put 4.5 times, 47%. Currently, I would put my stop just right here, about $37.5. So about a 6% risk for a 47% return. That's a 7-to-1 risk to reward ratio. I like that one as well. Another ETF that might even be better than this, because this ETF is for gold miners. So there's an ETF that is actually for the gold commodity itself. Gold itself is a very slow moving commodity. If you look at a chart of gold, you can see that the chart is looking like it's likely to go up. The first thing we have to do is look out for this resistance here. Gold could fail around $2,400. But I feel like gold has a long way to go, because we know that after a cup and handle has been completed, it normally first has to do a correction and then it will move up again. So I think it's likely to have a huge move up. But when we look at the correction, we're not seeing a complete double bottom. So I don't like this correction in gold, but the price jumped out of this line here, and I think it's likely to go up. So we have to wait and see how it reacts at around 2,400. If it fails at that price, then it's not yet ready to go out. But if it passes through that, then it's time to celebrate. But gold itself, if you look at the 1.5 average true range of gold, it's just 1.78%. So gold normally moves about 1% per day, which is very small. So that's why it's always better to have the leveraged ETF. And what is a leveraged ETF? It even has a funny name. It's called Shiny. So Shiny is an ETF. So it's times 3 of gold. This one has about 4.6 average true range. So it's times 3 of gold. So currently it has a lot of gaps because it's a new ETF and people are not trading it as much. But for ETFs, they're not like stocks. If they have low volume, they're still okay. I would just put a 4% loss because I know I don't want it to come down and fill this gap. And I would put my reward to be around 20 to 30%, of course. So put 25%, 6-to-1 risk to reward ratio. This is a good ETF to get in as well. So you have several options. You have the stocks, you have the ETFs. Don't forget the resistance that we talked about. If it fails at those resistances, it's likely it's not going to go up. So that means you can exit your trade without even making a loss. So of course, for this ETF has a line of resistance here around 40. So see how it reacts. If it comes out here, fails at 40, you can still even exit for a 10% profit. But it's not going to be the huge 30 to 20% that we talked about. So let's wait and see. Because this ETF already moved around 50%. I expect such a huge move, even bigger than that from here. But we don't predict the future. We can only make a calculated guess. So let us wait and see what the future holds. I hope you've enjoyed the video. Subscribe to the channel for more lessons like this. And of course, sign up for my newsletter. If you sign up, you'll be getting a free detailed lesson on my most profitable strategy that gave me 80% in just 2 weeks. So I hope you enjoy that, and may the markets be with you. Thank you.